Hi guys, in this video I'll show you how the Crypto Volatility Indicator could have saved my trading bot from losing over $5,000 in profits last month. I'll show you three things. I'll show you how the Crypto Volatility Index works and what it actually measures. Then I'll test it against my real Hyperliquid trading account for last month, July 2026. And then finally, I'll give you a free AI prompt that you can copy and paste into your system to perform the analysis on your own trading history to see if the Crypto VIX indicator can make your trading bot more profitable. Before we start, let me explain the problem. So when trading the stock market, the general risk management advice is when the volatility is high, you trade smaller, like you size down your positions. But crypto trading is different to stock options trading. And so I wanted to verify if sizing down my positions in crypto was actually more profitable for my account. So I decided to put my theory to the test on my own real money account on Hyperliquid. The question isn't really, is volatility bad, but which volatility conditions actually win more and which ones lose more? And how can we use the crypto VIX indicator to apply better risk management to our trading agents? So if we take a look at the current Crypto Volatility Index on cryptodataapi.com, we can see that the current volatility is at 137%. It's a slight elevation in the realized volatility compared to the previous 30-day average. There are two metrics worth considering here. One is the realized volatility, and two is the implied volatility. Now, the realized volatility looks backwards. So how much did the price actually move previously? And this CVI index measures that across all the major cryptocurrencies, and it's weighted by volume, and it protects the index against the thin book, highly volatile coins. Whereas the implied volatility looks forward. Now, this is what the options market expects to happen. So currently in crypto, there is only Bitcoin and Ethereum that have options trading. So we only have data for those two measures. But the gap between the realized volatility and the implied volatility is called the variance risk premium. Now, usually when this gap is positive, the people selling the volatility, they're getting paid on those options. But because this is crypto, not stock market, to test this volatility indicator against my real Hyperliquid completed trades, I created a composite score metric. It's a simple 0 to 100 stress score. So how much of the whole market is in a stressed volatility state? So the higher the composite score, the more the market is under pressure. For the backtesting, I used the Cryptodataapi MCP server to test the crypto volatility indicator against my Hyperliquid crypto trading history for last month. I also used the Volatility Composite Score metric. So it's a simple metric that goes from 0 to 100, and it's a stress score for the whole crypto market. So, for example, how much of the whole market is in a stressed volatility state? So the higher the composite score towards 100, the more the market is under pressure, and the lower the score towards 0, the less the market is under pressure. I separated this composite score into three data ranges. So band A is the calm market between 53 and 54.7 composite score. Band B is the ramp market, which is the transition between 55, 56.7 composite score, and band C, which is the peak market volatility, which is above 58.2 composite score. Now I'll show you my backtest results, and then I'll show you how you can run it on your own trading account. So last month, my bot took 921 real crypto trades with a profit of $987, a win rate of 59.8%, and a profit factor of 1.05. So it's not amazing stats, but at least it made profit. So now watch what happens when I split the trading backtest results by volatility band. You can see that the calm band with a composite stress score of under 55 made $2,226 across 104 trades. The middle ramp, stress score between 55 and 58, took a massive loss of $5,737 across 323 trades. And finally, the peak band with a composite stress score of above 58 made a decent profit of $4,457, with also the highest win rate of 69%. So if we look at that middle band, which is named ramp, it looks like this account didn't get broken by chaos, but it got broken in transition on the ramp up between calm and peak volatility. Now, if I was to guess why this is happening, my theory is as follows. So when the volatility is low, the ranges are tight and they hold. The stop loss sits close to the entry and the mean reversion behaves normally. Prices drift and the prices revert back, which is great. And likewise, when the volatility is high, the market is openly trending, the price moves are bigger, the direction is more sticky, and the strategy that follows any trend will work very well. So in between the low and the high volatility, we have the transition phase, which is band B. And we can see that range logic breaks because the range is widening underneath it. And the trend logic also hasn't kicked in yet because there's no trend to follow. And I think that's what's actually happening. So I think we can use this market volatility data to determine which strategies we trade in which conditions. And more importantly, should we even be trading at all in some volatility conditions? So for example, between composite score 55 and 58, it's clearly losing. So we'd be better off not taking those trades at all. And if we just traded in band A and C and ignored band B, then we can see that we would have made over $5,000 more profit in this trading account for last month. A quick disclaimer. So these are my results on a small sample size from last month, but your trading setup might be different to mine. And so your results will be different to mine. So if you want to run the Volatility Index backtest analysis on your own trading history, then you can do that by heading over to cryptodataapi.com/prompts and copy and paste the prompt volatility band profit and loss audit into your AI agent. The prompt uses the MTP server, which you can get a free API key to run the backtest. It pulls the live history from your Hyperliquid account. It pulls the Crypto Volatility Index data from the API, and it compares the profit and loss for each trade. If you trade somewhere else like Binance, it's easy. Just export your CSV trading history and then run the backtest prompt on that. The Data API also provides individual coin volatility regimes that label every asset as compressed, expanding, volatility shock, mean reverting, or normal. And it also tells you how many days the coin has been in the current regime. You can also get the implied volatility and the options pricing premium data feeds for Bitcoin and Ethereum, which could be useful for testing different trading strategies. Before you go, guys, remember the data is the edge. And if you want high quality crypto data for your AI agents, then head over to cryptodataapi.com, use the discount code SOCIAL50 to get 50% off your first 3 months on the professional data subscriptions. Thanks for watching, guys. And if you found this helpful, please drop us a like and a comment. And I'd love to know if your trading account produced the same volatility index results as mine. And as always, guys, we'll see you in the next one.